Rituraj Sinha, Group MD, SIS India, joins in to share his outlook. Thank you so much for joining in. Now, in the conference call, post the numbers, you mentioned that after a slowdown in FY22, you're expecting a return of 20% plus growth, that kind of a run rate in FY23. Are you sticking to that target, and which is the segment that's going to be driving growth for the company?
Well, thanks for having me. I think, the first data point I'd like to share with you is that SIS listed in 2017, and 5 years since that, we have maintained a 17% CAGR for this 5-year period. And this 5-year period has been marred with economic slowdown first, and then, we've also witnessed disruption because of COVID. So that is the power of essential services as an industry. Our growth potential is tremendous, and SIS is shooting for market share consolidation through organic means. Our first quarter looks strong, and we are quite hopeful that saving any unforeseen events and disruptions, we could be on track for a very solid 20% type growth in India. India is looking fairly strong, and as far as business lines is concerned, it's a secular revival in security, in facility management services, and in cash logistics.
Fair enough. So for the company in specific, you have guided that your pre-pandemic EBITDA margin of 5.5% to 6% is going to be back. Are you confident about that? Because analysts say, it might not be feasible. Margins may stay close to 5%. So just walk me through the margin levers, essentially, Rituraj.
Well, the margins will take a little bit of time to recover. When we have very rapid organic growth, there are contract onboarding costs, and those are one-time costs, initial setup costs, and we've also sort of pushing for growth, so we have expanded our sales force. Branch openings that were pending for last 2 years have been all initiated. So there are factors like that, but over a 4-quarter cycle between Q1 FY23 and Q4 FY23, I think the margin will stabilize and move pretty close to our pre-COVID normal levels. And I can say that because our gross margin remains pretty stable. So whatever is happening on the EBITDA line is largely because of SG&A changes. First it was the COVID-related vaccination PPE cost that pushed the EBITDA down, and now it's a little bit of going back to growth expenditure that is reflecting on the EBITDA margin line. But I think as we pick up revenue, this will normalize, and hopefully we will be back at the 5.5% range by Q4.
Right. So if you could also just talk about in the pre-COVID and in the post-COVID, how do you see demand for people? People are now willing to keep 1 or 2 more people because they believe that anytime they may have to get strict, or they need this sort of checking going into the office. So are the number of people that they're actually looking in for security, are they more skilled? Some people who are keeping less number of people are now coming back to the normalized because they know that sometime it can occur again.
Well, the way I look at it is that what COVID has done for us is establish and underline the fact that private security, facility management, and cash logistics are absolutely essential services, like banking, like healthcare, like e-commerce. When India witnessed lockdowns, it was a security guard and the CCTV cameras which were basically standing guard. When India was reopening, whether it was malls or offices, the facility management guys ensured the hygiene and disinfection services to keep it a safe workplace or a safe environment for hotel guests or mall guests. Cash logistics is the lifeline. No matter what happens in this country, you need to keep the ATMs running. So I think all of our customers have truly realized that this is an essential service, and they want to work with, larger, more organized, and more reliable operators who have the necessary capacity to meet, these kind of disruptions. Uh, so what we are witnessing is more business from existing customers and a lot of new customers moving into SIS fold, because through the COVID period they've witnessed that they need to operate with a more reliable essential services provider. So whether it's manpower or technology services, both ways, demand is higher.
Right, sir. So one of the investors earlier had told me that in the last few weeks or months, what has changed is that there is a higher compliance pressure. Even though the retention rate of the labor is particularly high, there is a very high compliance and labor regulatory system which is hurting the small players. How will that help in market share gains?
Well, I think creation of labor reforms will essentially create a level playing field. Today the compliance environment is such that a lot of fly-by-night operators tend to exist in this sector, and that's clearly reflected in the fact that SIS, being India's largest security company, close to the largest FM company, barely has 4-5% market share. It's a highly fragmented market. So I believe that as labor reforms come and they get implemented, a level playing field will be created. Customers will move to compliant operators, because as principal employers, the obligation for labor compliance lies with the user of services, which is the customer in our case. So we believe that this will usher an era of organic and inorganic consolidation in the sector, as one has witnessed in the international markets, where market leaders hold up to 50% market share in mature markets. So I think this is the beginning of the change, and a path of market leaders from a single digit market share to a double digit market share, and that is what SIS is aspiring for.
Good morning. This is Nantar also joining in on the conversation. I wanted to understand, for a company like yours, what is it going to mean for manpower, for recruitment, for the labor force, when you now have the central government, the defense forces, talking about a massive recruitment of 10 million people from the youth? I'm of course talking about the Agnipeeth program that was unveiled yesterday. Is that going to have any impact?
Well, we welcomed the Agniveer program yesterday. I think it's a very good move on behalf of the government. We believe that industry in general and private security in particular are going to benefit from a large pool of well-trained young individuals who will be coming out of the program at barely the age of 25, and they're going to be fantastic resource, skilled employees that we look forward to having. So I think we are quite excited about this move by the government.
Okay, so you basically think that it's going to add to the labor force, and the gig economy. Firms like yours have, of course, been struggling with reverse migration that we had seen in COVID-19, and just picking up from what Pankaj and my colleague had also asked you, that is completely normalized now?
Well, right now we are back to normal. I think all offices are, industrial sector was anyway working at full capacity. It was the commercial sector which was struggling with footfalls initially. That at hotels and malls seems to be largely normalized. Some MNCs continue to operate or give flexibility about work from home, but mostly are getting back to full capacity, work from office. So I personally believe that we are pretty much back to back to pre-COVID levels of normalcy, and clearly growth is coming back, and it is clearly visible from the additional work orders we are getting from existing customers who are in expansion mode.
Thank you so much, sir, for taking out time for us. Always good to get perspective from you.